Hello, it's What Would Peter Lynch Do? Time to explore the wisdom of legendary investor Peter Lynch. Today is June 2nd, and he says the U.S. stock market is shaking due to the rekindling of the U.S.-China trade conflict, and the index has only risen slightly.
That quote, wow, it really hits home right now, doesn't it? I mean, the market is definitely reacting to those U.S.-China trade talks restarting. You can sort of feel the nervousness.
You really can. And that whole reaction, it ties perfectly into a great question we got from you, our listener. You asked, what do rising inflation, slowing economic growth, trade friction, and interest rate forecasts have to do with the stock market?
Yeah, that's a big question. It gets right to the core of, well, everything investors are wrestling with at the moment.
It really does. These aren't just, headlines. They're real forces impacting company values, the whole market outlook.
Absolutely. They're interconnected.
So our mission today in this deep dive is to take these pieces, inflation, growth, trade, rates, and unpack what they actually mean for the stock market using the source material you sent over. And then, the key part, look at it all through Peter Lynch's very distinct perspective.
Right. How would someone like Lynch think about all this macro stuff swirling around?
Exactly. We want to understand the big picture, but also figure out how Lynch might suggest, an investor should respond, or maybe not respond.
Okay, let's dive in.
Great. So let's start where that Lynch quote points us to the current market, June 2nd. The sources say the U.S. market is, well, sensitive, shaking, maybe an overall decline, or only risen slightly, as Lynch put it. And it seems mostly pinned on this renewed U.S.-China trade stuff.
Well, that sensitivity, it makes a lot of sense, doesn't it? Trade issues throw a huge wrench into the works for companies, especially ones that operate internationally or rely on global supply chains.
It creates a sort of pause, right? Makes
Right.
businesses hesitant.
Definitely. A big pause button on making decisions, on investments.
And that hesitation, that market sensitivity, it's not just about trade now, is it? The sources also flag that the market's really watching rising inflation and signs of slowing economic growth, too.
That's crucial. And, as the material highlights, these things aren't separate. They're tangled up together. It's like a complex feedback loop the market's trying to figure out.
Okay, so let's break down that listener question piece by piece. First up, rising inflation, slowing growth. What's their connection to the stock market? How does that actually work?
Okay, well, inflation's the starting point, really. It's just prices going up generally, right? So the money in your pocket buys less. Your purchasing power drops.
Yeah, you feel that. Groceries, gas, everything seems to cost more.
Exactly. And that feeling, that pinch in your wallet, it scales up to the whole economy. If prices are high, people just, well, they can't buy as much with the same paycheck. Real spending power is down.
So we buy less, maybe cut back on extras.
Precisely. People might dine out less, put off buying a new gadget, things like that. That means less spending overall.
And less spending means lower sales for companies.
Spot on. Less consumer spending hits companies' revenue, their top line. And if revenues slow down and maybe their own costs are rising because of inflation elsewhere, well, companies start looking to protect their profits.
Which usually means cutting costs. Maybe less hiring, delaying big projects.
That's often the first reaction, yeah. If a company isn't sure about future sales or its costs are climbing, it's probably not going to rush into building a new factory or hiring a bunch of new people.
So all these companies tightening their belts together, that's what slows down the whole economy.
That's the mechanism, yeah. It's this kind of spiral. Inflation cuts spending power, less spending hurts company revenues, companies cut back, and that leads to slower overall economic growth.
So that's the basic link the sources are drawing.
That's the core correlation. And the material mentions that if this cycle gets really bad, rising prices and slowing growth together, you can end up in what's called stagflation.
Stagflation. I remember hearing about that.
Oh.
That's the nasty mix, right? High inflation and a stagnant economy at the same time.
Exactly. And it's tough because the usual fixes for one problem can make the other worse. Like, hiking interest rates might cool inflation, but it could also slam the brakes harder on an already slow economy.
Tricky situation.
Very. The sources also mention why this inflation might be happening. Things like demand pull, too much money chasing too few goods, or cost push, where the costs of energy or materials or labor shoot up. Different causes, but the effect on consumers and growth is similar.
Okay, that helps clarify the inflation growth link.
Yeah.
Now, what about the trade friction Peter Lynch mentioned, like the U.S.-China situation? How does that specifically mess with the economy and the market?
Right. Trade conflict adds another layer of, well, cost and uncertainty. Things like tariffs, basically taxes on imports, have pretty direct effects.
How do tariffs connect back to inflation?
Very directly. If the U.S. puts a tariff on, say, Chinese steel, as the source mentions,
Uh-huh.
that steel costs more for American companies that buy it. Maybe a car maker, for instance. Their costs go up, so they might have to raise the price of the car.
So it pushes prices up for the end consumer. That's cost-push inflation again.
Exactly. It's an inflationary pressure right there. And then, of course, the other side usually hits back. Retaliation. The source mentioned China might put tariffs on U.S. stuff, like soybeans or pork.
So American farmers trying to sell soybeans to China suddenly face higher costs for their buyers there. That must really hurt their exports.
It does. It cuts off markets, reduces potential revenue, and just creates massive uncertainty. Who wants to invest in expanding their farm if they don't know if they can sell their product next year?
Yeah, makes sense.
And beyond the direct costs and lost sales, just the uncertainty itself is a big problem. Companies get hesitant about long-term plans, building a factory, launching a new product line. These things rely on some stability. Trade wars make planning incredibly difficult.
It disrupts all those global supply chains companies rely on too, I bet.
Totally messes with them. Companies have spent years finding the most efficient ways to get parts and build things globally. Tariffs and trade barriers force them to rethink everything, find new suppliers, maybe move production. It's all costly and disruptive. Adds more uncertainty.
And all that, the higher costs, maybe lower export sales, the investment delays, the supply chain chaos.
Yeah.
How does that translate to the stock market? Investors must react to that.
Oh, absolutely. When companies face these kinds of challenges, their future profit forecasts often get revised downwards. Lower expected profits generally mean investors see the stock as less valuable.
So stock prices can fall.
They certainly can. And you see more volatility, more jumpiness in the market overall. Trade conflict is seen as a direct threat to company earnings.
Okay, so we've got inflation and growth slowing things down, trade adding costs and uncertainty. Now, the last piece of the listener's question, interest rate forecasts. What's their role in all this for the stock market?
Interest rates. That's another huge one. What the Federal Reserve, the central bank, is expected to do with interest rates, that has a massive influence on stocks and other assets.
Why are rates so powerful? What's the mechanism?
Well, think of the Fed's main interest rate as the base cost of borrowing money across the economy. So if everyone expects the Fed to raise rates, it signals that borrowing is going to get more expensive. For companies, that means loans for new projects, for R&D, even for managing daily cash flow might cost more.
More expensive borrowing. So companies might invest less, maybe slow down hiring again.
That's a typical result, yes. If a project doesn't look profitable enough after factoring in higher borrowing costs, maybe they shelved it. And for regular people, higher rates mean mortgages, car loans, credit cards get more expensive. That can dampen consumer spending, especially on big purchases, feeding back into that slower growth picture.
Okay, and for stocks directly.
Higher rates can hit stock prices a couple of ways. First, if companies are expected to make less profit because borrowing costs more and demand is lower, well, the stock just isn't worth as much fundamentally. Second, when interest rates go up, safer investments like government bonds start paying more.
Right.
So those safer bonds become more attractive compared to riskier stocks. Some investors might shift money out of stocks into bonds, pushing stock prices down. Also, higher U.S. rates can make the U.S. dollar stronger, which sounds good, but it makes U.S. exports more expensive for foreign buyers, hurting companies that sell overseas.
Okay, so expectations of rate hikes are generally bad news for the market. What about the opposite expectations of rate cuts?
That's usually seen as positive, a tailwind. Lower rate expectations mean cheaper borrowing. That encourages companies to invest, expand, hire. For consumers, loans become cheaper, potentially boosting spending on houses, cars, etc.
So potentially good for company profits and the economy.
Generally, yes. Higher expected profits can boost stock prices. And lower bond yields make stocks look relatively more attractive again. Lower rates might also weaken the dollar a bit, making U.S. exports cheaper and more competitive.
Wow, it really is a tangled web, isn't it? Inflation, growth, trade, rates, all interacting, sometimes pushing in different directions.
It absolutely is, and that captures the situation the sources describe right now, I think. The market is struggling because you've got this renewed trade tension, adding uncertainty, you've got stubborn inflation, you've got signs of growth cooling off, and there's confusion or disagreement about what the Fed will do next with rates. There's just no simple, clear story.
Okay, so we've laid out this really complex picture, a market getting pushed and pulled by these huge macro forces. It feels Kind of overwhelming, honestly. How is an investor supposed to deal with all this? Which brings us right to Peter Lynch.
Yes, exactly. Because while everyone else is obsessing over every inflation number, every Fed statement, every trade tweet, Peter Lynch famously took a very different path.
Yeah, he wasn't exactly known for timing the market based on economic forecasts, was he?
Not at all. His whole philosophy, as the sources highlight, was basically don't get too caught up in trying to predict or react to these big picture macro things.
He had that great quote, didn't he? The one about economics.
He did. The sources mention it. If you spend 13 minutes a year on economics, you've wasted 10 minutes.
Chuckle slightly. I love that. He's essentially saying, for the average person, trying to predict the economy is mostly a waste of time.
That's the gist. The idea behind it is that predicting the macroeconomy is just incredibly hard. It's uncertain, things change fast. So Lynch said, focus your energy on what you can understand and analyze, the specific company you're thinking of investing in.
So less worrying about global steel tariffs, more looking at the actual company that uses steel, understand its business.
Exactly. He drilled down on the fundamentals. What's the company's business model? How does it make money? Does it have a competitive edge, something special? Is it financially healthy, strong balance sheet, good cash flow? Is management any good? Does it have real potential to grow over time? It all comes back to his famous advice. Invest in what you know.
You can actually get your head around a company's product or its financials way better than you can predict, say, future interest rates or geopolitical events.
Right. And his reasoning, according to the sources, was partly that macro prediction is just too difficult. The global economy, politics, countless variables, rapid changes, even the experts disagree constantly. So betting your portfolio on your own macro guess, very low odds.
Better to stick to what you can reasonably analyze.
Precisely. And tied to that was his long-term perspective. He believed great companies, the ones with solid fundamentals, are resilient. They might face headwinds from inflation or trade issues in the short term, sure. But if the core business is strong, it can navigate those challenges and keep growing over the long haul, over years or decades.
So the stock price might dip because of scary headlines, but the actual value of a good company keeps compounding underneath.
That's the opportunity Lynch looked for, according to the sources. Short-term market moves are often driven by fear or greed, by the news cycle. That can make the price disconnect from the company's real long-term value. Lynch saw those panic moments as chances to buy good companies cheaper, trusting the fundamentals would eventually shine through.
And trying to trade in and out based on every economic report or news flash.
That leads to exactly what Lynch warned against. The sources point this out. It results in frequent emotional trading. You end up buying high and selling low, paying fees and taxes, and hurting your long-term returns. His approach was about patience, conviction based on the company itself, not guessing the macro direction.
So just to be clear, he wasn't saying macro factors have zero impact, just that they shouldn't be your primary focus.
That's the key distinction, yes. The sources make it clear he understood companies operate in the economy, but he thought good companies could handle it. They were a passable wave, as the source says. They can adjust to higher costs, figure out supply chain issues, survive slowdowns, maybe even benefit if competitors struggle. The wisdom is keeping your focus on the strength of the company, its long-term path.
That perspective, it really does cut through the noise, especially when things feel as confusing as they do now. It brings focus back to what you, the investor, can actually research and understand. And I'll say a word from Lynch today and say that this principle is connected to wisdom in life as well as investment decisions.
Oh, that's a really interesting connection. Yeah, think about it. In life, just like investing, we get hit by all sorts of external stuff we can't control, right? Big global events, changes in our communities, tech shifts. It's easy to get overwhelmed by the macro of life.
Yeah, spending all our energy worrying about things way outside our influence.
Exactly. But the Lynch approach, focusing on fundamentals, it kind of reminds us that resilience, real progress, often comes from focusing on the micro, the things we can understand and build, our own personal fundamentals.
Like what? Our skills, relationships.
Yeah, exactly. Things like nurturing relationships, developing skills, taking care of our health, working towards our own goals. Those are the areas where our effort actually makes a difference, where we have some control. It's about building our own internal strength.
Instead of just being blown around by external events.
Precisely. Staying calm when things get chaotic. Keeping a long-term view on our own path. Focusing energy on what we can build. It really does parallel the investment wisdom. Trying to react to every single external shift in life can be just as exhausting and counterproductive as trying to time the market based on headlines.
That really adds another dimension to why his advice resonates so much.
It does, doesn't it? It's about focus and agency in a really complicated world.
Okay, so wrapping up this deep dive, which started with your really insightful question, we've seen that yes, macro factors, inflation, growth, trade, rates, they absolutely create a complex, often volatile market backdrop. But Peter Lynch's wisdom, as reflected in these sources, powerfully suggests that investors are probably better off not trying to predict these huge, unpredictable forces.
Right. The better path is likely focusing that energy on understanding the actual businesses, their fundamentals, their long-term prospects.
It's about looking past the short-term market noise to see the underlying, enduring value of strong companies, trusting they can navigate the storms over time.
That's the core message, I think.
Which leaves us with maybe a final question for you to think about. In today's world where everything feels so interconnected, a trade issue here instantly affects supply chains and prices over there. What does it really take to truly know a company, Lynch style? How can we apply that fundamental focus effectively without getting totally overwhelmed by all the global complexity and unpredictability? It's a real challenge finding that clarity.
It is. A challenge worth thinking about for any serious investor today.
See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.